Hello, my dear students. A very warm welcome to all of you in Shri Jayendra Rank Zone. I am your friend and mentor for the subject Principles and Practices of Accounting. In this lecture, we'll continue with Accounting, Chapter 10, Unit 2, Issue, Forfeiture and Reissue of Shares. Let us continue. Oversubscription. In actual practice, issue of share is either under or oversubscribed. If an issue is oversubscribed, some applications may be rejected and application money refunded, and in respect of others, only a part of the shares applied for may be allotted, and the excess amount received can be utilized towards allotment or call money which has fallen due or will soon fall due for payment. The entries are on refund of application money to applicants to whom share have not been allotted, share application account debit to bank account, being application money refunded. Next, when only a part of the share application applied for and allotted, share application amount account debit to share allotment account with the application money accepted for allotment. 2. Calls in advance with the amount received in advance to bank account with any excess amount be refunded, being application money adjusted, credited to share capital account subsequently. Note, this type of share allotment is termed as pro rata allotment, partial allotment, and has been discussed in detail. Next illustration, illustration 4. Pant Limited invited applications for 50,000 equity shares of rupee 50 each, which are payable as on application 20, allotment 10, and first and final call 20. The company received applications for 60,000 shares. The directors accepted applications for 50,000 shares, and shares are rejected the rest, that is 10,000 shares. Show journal entries if companies refunded the application money to rejected applicants and allotment money was received for 45,000 shares. Solution. Pant Limited Journal. Particulars: debit, credit. First entry: bank account debit to share application account. Application received for 60,000 share and application money is 20 rupee per share, 12 lakhs. Share application account debit 12 lakhs to equity share capital 50,000 multiplied by 20. 50,000 shares multiplied by 20 is 10 lakhs to bank account 2 lakhs. Next, equity share allotment debit to equity share capital 5 lakhs 5 lakhs 50,000 multiplied by 10. Next entry, bank account debit 45,000 we have received for 45,000 multiplied by 10, 4,50,000. Calls in arrears debit 50,000 to equity share allotment 5 lakhs. I believe you understood. I believe you understood this. Let us move ahead. Illustration 5. The Delhi Artware Limited issued 50,000 equity shares of 100 each and 1 lakh preference shares of 100 each. Equity shares and preference shares on application, on allotment, first call and final call. The monies received are specified over here. All these shares were subscribed. All the 50,000 shares were subscribed. Final call was received on 42,000 shares in case of equity share and 88,000 preference shares. Prepare the cash book. Journalize the remaining transactions in the books of the company. I believe you understood. Solution. Delhi Artware Limited cash book. Delhi Artware Limited cash book. Particulars amount journal, journal book, debit rupees, credit rupees, particulars, first entry is on application, bank to equity share application, on equity share 25,000 multiplied by 50,000, and for preference share bank to preference share application 1 lakh multiplied by 20. Put the entry in the cash book to equity share application. To equity share application 50,000 into 25, 12 lakh 50,000 to preference share application. One lakh into 20, 20 lakhs. I believe you understood. Then there would be entry for allotment, bank to equity share allotment and bank to preference share allotment. Right, to equity share allotment, to equity share allotment 50,000 share multiplied by 20, 10 lakhs to preference share allotment 1 lakh multiplied by 30, 30 lakhs to equity share first call, to equity share first call 50,000 multiplied by 30, 1 lakh 15 lakhs to preference share first call 1 lakh multiplied by 20, next is to equity share final call, to equity share final call 42,000 shares into 25, 10 lakh 50,000 to preference share final call 88,000 share into 30, rest were call in arrear, so 26 lakh 40,000 total. 1,444,0,000. So this is by balance carried down. By balance carried down. Now come to journal entries and put rest of the journal entries for the same. Equity share application, equity share allotment, equity share allotment. For equity share application, 12,50,000. For equity share allotment, 10 lakhs. To equity share capital, 22 lakhs 50,000. Next is preference share application, debit, preference share allotment, debit, preference share application 20 lakhs, preference share allotment 30 lakhs. To preference share capital, 50 lakhs, 50 lakhs. Equity share first call, debit, 15 lakhs. To equity share capital, 15 lakhs. Preference share first call, debit, to preference share capital, 20 lakhs. And at last, final call, equity share final call, debit, to equity share capital, to equity share capital, 12,50,000, 12,50,000. Preference share final call, preference share final call debit, to preference share capital, to preference share capital, 12,50,000. For preference share final call 30 lakhs. For preference share final call 30 lakhs. I believe you understood. Let us move ahead. Next topic, issue of shares at discount. Shares are regarded to be issued at discount if issue is at an amount less than the nominal value or par value of shares. The excess of the nominal value over its issue price represent the discount on the issue of shares. Example, when the shares nominal value is rupee 100 and the shares is actually issued at 98, it is said to have been issued at a discount of 2%. According to Section 53 of the Companies Act, a company cannot issue shares at a discount except in the case of issue of sweat equity shares issued to employees and directors. Thus, any issue of shares at a discount shall be void. Company cannot issue shares at a discount. Issue of share at a premium. When a company issues its securities at a price more than the face value, it is said to be an issue at a premium. Premium is the excess of issue price over the face value of the security. It is quite common for the financially strong and well-managed companies to issue their shares at a premium, that is, at an amount more than a nominal value or a par value of shares. Thus, where a share of the nominal value of rupee 100 is issued at 105, it is said to have been issued at a premium of 5%. When the issue is at a premium, the amount of premium may technically be called at an stage of share capital transaction. However, premium is generally called with the amount due on allotment, sometimes with the application of money and rarely with the call money. Accounting treatment. When shares are issued at a premium, the premium amount is credited to a separate account called securities premium account because it is not a part of share capital. Rather, it represents a gain or a gain of a capital nature to the company. Being a credit balance, securities premium account is shown under the heading reserves and surplus. However, reserves and surplus is shown as shareholders fund in the balance sheet as per Schedule 3 according to Section 52 of the Indian Companies Act 2013. Securities premium account may be used by the company. First, towards issue of unissued shares of a company, to be issued to members of the company as fully paid bonus certificate securities. Next, to write off preliminary expenses of the company, to write off preliminary expenses of the company, to write off expenses of commissions paid and discount allowed on any of the securities or debentures of the company, to provide for premium on the redemption of redeemable preference shares or debentures of the company, and for the purchase of own shares or other securities. Note, it may be noted over here that certain class of companies as prescribed under Section 133 of the Companies Act 2013, whose financial statement comply with accounting standard prescribed for them, can't apply the securities premium account for the purpose B and D mentioned above. When shares are issued at a premium, the journal entries are as follows. First, premium account called with application money, bank account debited to share premium account. Next, bank account debited to share application account. Next, share application account debit to securities premium account. The number of shares allotted multiplied by the premium amount per share collected to share capital account. When premium amount called with the allotment money, then share allotment account debit to share capital to securities premium on allotment and bank to share allotment inclusive of the amount of premium. I believe you understood both the cases. Case A, premium amount called with application money, and case B, premium amount called with allotment money. Illustration 6. On 1st October 2017, Pioneer Equipments Limited received application for 2,50,000 equity shares of 100 each to be issued at a premium of 25%. On application rupee 25, on allotment rupee 75 inclusive of premium, so it is 50 plus 25. 50 allotment money and 25 is the premium. Balance amount on shares as and when required. The shares were allotted by the company on October 20, 2017 and the allotment money was duly received on 31st October 2017. Record journal entries in the books of the company to record the transactions in connection with the issue of shares. Solution. Pioneer Equipments Limited, Pioneer Equipments Limited, Journal, Journal, Date, Particulars, Ledger Folio, Debit, Credit. First entry, 1st October, bank account debit to equity share application, to equity share application, 2,50,000 shares of 25 each, 62 lakhs 50,000. On October 20, equity share application, equity share application debit to equity share capital. To equity share capital 62 lakhs 50,000. 62 lakhs 50,000. On October 20, equity share allotment. Equity share allotment debit to equity share capital to securities premium to securities premium account to equity share capital to equity share capital 2,50,000 multiplied by 50 and to securities premium 2,50,000 multiplied by 25. Let us move ahead. On 31st of October, bank account debit to equity share allotment to equity share allotment. In the previous entry, write the amount 18750,000 18750,000. I believe you understood till here. I believe you understood till here. Let us move ahead. Oversubscription and pro rata allotment. Oversubscription is the application money received for more than the number of shares offered to the public by a company. It usually occurs in the case of good issues and depends on many other factors like investors' confidence in the company, general public conditions, pricing of the issue. When the shares are oversubscribed, the company cannot satisfy all the applicants. It means that a decision is to be made on how the shares are going to be allotted. Shares can be allotted to the applicants by a company in any manner it thinks proper. The company may reject some applicants in full, that is, no shares are allotted to some applicants and application money is refunded back. Usually, multiple applications by the same person are not considered. Allotment may be given to the rest of the applicants in full for the number of shares they have applied for. A third alternative is that the company may allot shares to the applicants on pro rata basis, partially. Pro rata allotment means allotment in proportion of shares applied for. For example, a company offers to the public 10,000 shares for subscription. The company receives application for 12,000 shares. If the shares are to be allotted on pro rata basis, applicants for 12,000 shares are to be allotted 10,000 shares. That is, on 12,000 we have given 10,000 shares, 6:5 ratio. Any applicant who has applied for 6 shares will be allotted 5 shares. Under pro rata allotment, the access application money received is adjusted against the amount due on allotment or calls. Surplus money after making adjustment against future calls is returned to the applicants. The applicants are informed about the allotment procedure through an advertisement in leading newspaper. When there is a pro rata allotment, the total application money paid by an applicant is more than the exact amount due on application. The excess amount is treated as an advance against allotment or any other future calls. The net amount due on allotment or any other calls is the difference between the amount due on allotment or any other calls and excess amount received on application. Accounting entries for rejected applications: share application account debited to bank. For pro rata allotment, share application account debited to share allotment account. Being access application money adjusted against allotment money as per the board of resolution number as given. Next is calls in arrears and calls in advance. At the time of receiving the value of shares in installment, that is calls, share call money received in full, bank account is debited with the full money received. Calls in arrear, that is money received, is less than due, then calls in arrear account is debited with the entry for the bank account. Calls in advance, that is money of future installment received beforehand in advance, then calls in advance account is credited with the entry for bank account. Starting with calls in arrears. Sometimes shareholder fail to pay the amount due on allotment or calls. The total unpaid amount on one or more installment is known as calls in arrears or unpaid calls. Such amount represents the uncollected amount of capital from the shareholder. Hence, it is shown by way of deduction from called up capital to arrive at paid up value of share capital. For recording calls in arrears, the following journal entry is recorded. Calls in arrear account debited, bank account debited to share allotment account to share call account. Do it once more. For recording calls in arrears, the following journal entry is recorded. Calls in arrear account debited, amount of capital unpaid calls, bank account debited, that is amount or money received, to share allotment, total allotment money due, share call, total call money due. Next is calls in advance. Some shareholders may sometimes pay a part or whole of the amount yet not yet called up. Such amount is known as calls in advance. According to table F, interest at a rate not exceeding 12% per annum is to be paid on such advance call money. This amount is credited in calls in advance account. The following entry is recorded. bank account debited to calls in advance account. When calls become actually due, calls in advance account is adjusted at the time of the call. For this, the following journal entry is recorded. Calls in advance account debit, call amount received in advance, bank account debit, remaining call money received, to particular call account, that is call money due. Being call in advance adjusted, and call money due received. Let us move ahead. Illustration 7. Shreyas Limited did not receive the first call on 10,000 equity shares at rupee 3 per share, which was due on 1st July 2016. This amount was received on 1st April 2017. After 9 months, open calls in arrear account and journalize the entries in the books of the company on 1st July 2016 and on 1st April 2017. Also, show an extract of balance sheet on 31st March 2017. Solution. Solution. Shreyas Limited Journal. Date, particulars, ledger folio, debit, credit. Over here, calls in arrear is 3 rupees on 10,000 equity shares. On 1st July 2016, 1st July 2016, calls in arrears account debit, calls in arrear debit 30,000 to equity share first call, to equity share first call account 30,000. On 1st April 2017, amount is paid, so bank account debit 30,000 to calls in arrears account, calls in arrears account 30,000. Being calls in arrears received, being calls in arrears received. I believe you understood. Let us continue. Interest on calls in arrear and calls in advance. Interest on calls in arrears and calls in advance. Interest on calls in arrears is recoverable, and that in respect of calls in advance is payable. According to provisions in this regard, in the articles of the company, the rate mentioned therein or those to be fixed by the directors within the prescribed by the article. Table F prescribes 10% and 12% as the maximum rate respectively for calls in arrears and for calls in advance 12%. I believe you understood. Interest on calls in arrears. It is payable by the shareholders to the company on the calls due but remaining unpaid. As per table F, the maximum prescribed rate is 10%. Period considered from the date call money was due to the date money is finally received. Directors have a right to waive off such interest in individual cases at their own discretion. It is a nominal account in nature and credited to statement of profit and loss account as an income. Interest on calls in advance. It is payable by the company to shareholders on the call money received in advance but not yet due. As per table F, the maximum prescribed rate is 12%. Period considered from the date money was received to the day call was finally made due. Shareholders are not entitled for any dividend on calls in advance. It is a nominal account in nature, with interest being an expense for the company. The book entries to be passed for the adjustment of such interest are much the same as those in case of temporary borrowings or loan raised, the only difference being that debits are raised and credits are given to the sundry members' account, and not the individual accounts of the shareholder in respect of interest recovered on calls in arrears or that payable on calls received in advance, the corresponding entries being made in the interest receivable or calls in arrear and interest payable or calls in advance respectively. The journal entries for calls in arrears are as follows. For interest receivable on calls in arrears, shareholders account debited to interest on calls in arrears, being interest on calls in arrear at the rate of specified percentage. For receipt of interest, bank account debited to shareholders account. The accounting treatment of calls in advance is as follows. Interest due. Interest on calls in advance account debit to shareholders account, being payment of interest. For the payment of interest, shareholders account debit to bank account, being interest paid on calls in advance. I believe you understood. Let us move ahead. Illustration 8. Illustration 8. Rashmi Limited issues at par 1 lakh equity shares of 10 each, payable 2.5 on application, 3 on allotment, 2 on first call and the balance on the final call. Rashmi Limited issued at par 1 lakh equity shares of rupee 10 each, payable 2.5 on application, 3 on allotment, 2 on the first call and the balance on the final call. That is 2.5 on the final call. All the shares were fully subscribed. That is all 1 lakh equity shares fully subscribed. Mr. Nair, who held 10,000 shares, paid full remaining amount on the first call itself. The final call, which was made after 3 months of first call, was fully paid except a shareholder having 1,000 share who paid his due amount after 2 months. Final call is 2.5, rupee 2.5. There was a shareholder with 1,000 shares. He did not pay 2.5 rupees each on final call. He paid it after 2 months along with the interest on calls in arrear. Company also paid interest on calls in advance to Mr. Nair. Give journal entries to record these transactions. Mr. Nair, who held 10,000 shares, paid full remaining amount on the first call itself. So Mr. Nair also paid the second and final call along with the first call. So Mr. Nair needs to be credited with the calls in advance. Solution. Bank account debit to equity share application account. Bank account debit to equity share application account. 1 lakh shares multiplied by 2.5, 2,50,000, 2,50,000. Equity share application. Equity share application account debit 2,50,000 to equity share capital to equity share capital 2,50,000. Next is allotment. Equity share allotment account debit to equity share capital to equity share capital 1 lakh, 1 lakh multiplied by 3 per share, 3 lakhs, 3 lakhs. Bank account debit to equity share allotment 3 lakhs. Let us move ahead. Share first call account debit to share capital 2 lakhs. Bank account debited to share first call 2 lakhs. Mr. Nair had paid calls in advance. Calls in advance. Mr. Nair held 10,000 shares. So 10,000 multiplied by 2.5. 25,000 shares. Total 2,25,000. 2,25,000. Last and final call. Equity share. Final call account debit 2,50,000, 1 lakh multiplied by 2.5 to equity share capital, to equity share capital 2,50,000. Next is bank account debited 2,25,000. Calls in advance, that is 25,000. Calls in arrears 1,000 multiplied by 2.5, 2,500 to equity share final call. Bank account debited to equity share final call 2,50,000. Calls in arrears 2,500 not received. Calls in advance set off, and bank account debited 2,225,000. I believe you understood. Now let us do the entries, record the entries for calls in arrears and calls in advance. So interest on calls in advance to shareholders, 25,000 is the calls in advance at 12% per annum. For 3 months. For 3 months it is 750. Shareholders account debit 750 to bank account 750. Next is calls in arrears. For calls in arrears, shareholders account debit to interest on calls in arrears 2,500 multiplied by 10% multiplied by 2 by 12. For 2 months it is 41.6666, that is 67. 41.6666, that is 67. And at last, bank account debited to interest bank account debited to calls in arrears which is 2500 to shareholders account 41.67, total 2541.67. I believe you understood. Till here. Let us quickly see what we have done in today's class. We started with understanding the concept of oversubscription. Then we done a sum on the basis of oversubscription. Share issued at discount. So we understood that shares should not be issued at discount. It is not allowed by the Companies Act. Share issued at premium is allowed. We have learned the accounting treatment of share issued at premium, how the journal entries needs to be passed. Then we done illustration 6, in which there was 25 rupees premium on issue of shares, over subscription and pro rata allotment. Then we learnt about the calls in arrears and calls in advance. We learnt the journal entries in relation to it, how to do the accounting treatment of calls in arrears and calls in advance. We solved illustration 7 in relation to it. Then we learned interest on calls in arrears and interest on calls in advance. So for interest on calls in arrear, table F prescribes 10% interest on calls in arrears and table F prescribes 12% for interest on calls in advance. We solved illustration 8 in relation to it. And this was the last illustration that we have did today in today's class. We are stopping here. We'll continue in the next class. We are stopping here. We'll continue in the next class. Thank you. Thank you.